Yeah, I'll send you a recording probably by this evening or tomorrow once it's ready. Okay, I'm going to share my screen. So the way this works is you'll get a link like this every and you just log on and we meet like this. Can you see my screen now?
Yes, I can.
Okay. So this is how we'll meet, and I'll record it so that you can go over the lesson, so you don't have to be scribbling notes quickly during the lesson or anything. So you'll get the recording. That will help. Okay. So we'll do 4 sessions, and then we'll take it from there. If you need any others after that, then we can talk about that. No problem. All right.
Okay, but along the way, if I do have questions, I could just drop you an email, right?
That's exactly correct. You can. What will happen is with these sessions, we will generate homework that I will expect you to submit during the week, and either I reply via email, or if it's stuff that I think it's better discussed one-to-one, I'll say to you in the email. We'll talk about it, and let's bring it to the next session, and we'll go over it in the next session as part of the next session. Okay?
Okay.
Because sometimes there are some topics that it's better we talk about it. And even if we go over it, even in the email, we can still bring it up during the sessions to just go over it, because I want you to understand this from the ground up. I don't want any missing links or misconceptions to get. We'll take time, build it brick by brick. Okay, so let's start with the concept of supply and demand. You've read the material, but I also want to talk you through some of it.
Okay.
It's pretty much based on economics, which is why it's a methodology that that resonates with me, that I really like, because it's based on sound, simple economic principles. When prices are rising, people generally believe, oh, that's because there are a lot of buyers. That's only half true. For example, when prices are going up in any market, the reason prices are going up is because people are buying, but also nobody's willing to sell. So if you imagine you have a car dealership, you sell what kind of cars are popular in Singapore?
I guess a BM.
Okay, so say you have a BMW dealership, and there are 2 or 3 in Singapore. Are you in the capital in Singapore?
Yes, Singapore is a state by itself.
Okay.
Capital by ourselves. Yeah. So.
Okay, so imagine you have 2 or 3 dealerships there, and now all of you have this BMW 7 Series that you are all selling, right? And the BMW is 20,000 Singapore dollars.
Okay.
And your dealership is selling it at 21,000.
Okay.
The other guy is selling it at 21,500.
Okay.
All right. Now I come to your dealership and I say, man, I really, really like this BMW 7 Series. It's beautiful. Can I? But the only thing is, I only have 19,000.
Okay.
You know that for you to make any profit on it, you have to sell it for 20. So you say, no, you're not going to sell it to me. That it's going for 20,000. That you can't sell it to me.
Okay. And
then I go to the next dealership, and he says it's 21,500 for him. And I go to him and I'm like, I really, really love this BMW. It's so my type of car. I really like it. You know, I've test driven. It's beautiful. I like the way it feels in my hand. I really want to get it. Can you do me a deal? Can you give me 19,000?
Okay.
And the guy said, what must I do to be able to buy that BMW from either one of the 2 of you?
For him to sell you at 19,000?
No, what must I do? If I've gone to the first guy, 20,000, he said no. I've gone to the other guy, 21,000, he said no. And I have 19. So everybody has refused me. What must I do if I want to buy a BMW, but I don't have enough money? What must I do?
You have to wait for price to drop.
I have to wait for prices to drop, or what?
Or to bid at a higher price.
Exactly. So I have to go and find. So that is what is called a seller's market, where there is demand. What I was trying to describe to you when I was saying I really love this BMW, I really want it, is the demand. There is demand for this BMW 7 Series. I'm the demand,
Okay.
right? But the sellers, you guys, the dealers, are not willing to sell to me.
Okay.
So I, the demand, have to raise my price. I have to find 1,000 Singapore dollars extra to be able to buy it at 20K. Does that make sense?
Yes.
So when prices are rising, let me just show you a picture. I'm doing a webinar tomorrow, and I was just preparing the slides. Maybe it's not here. No, it's not here. But let's look at a picture of a chart. Let me see if I can find it. Because I want you to get this. I really want you to get this. You can still see my screen, right?
Yes.
Okay, good. And I'm looking for the interrelationships. THE. Where is it? Let's look at page. Yeah, there we go. I got it. I'm going to be showing this slide as well tomorrow.
Okay. So I've got a first-hand view of it.
Yeah, you will. Do you see the picture?
Yes, I do.
Okay. So this is the interrelationship between supply and demand and price. So when prices are falling, demand is going up. Why? Because it's getting cheaper. So if you imagine a BMW in Singapore, say it's 20,000, and then you hear on the news that today 3 dealerships are in that car, that exact same car, that's 20,000, they're selling it for 17.
Okay.
Today. If you had 17,000, what would you do? You'd go and buy it, right?
Correct.
Because you just got 3,000 discount. So you know why people drop their prices at Christmas? You guys have Black Friday, Black Monday as well, and you have all these sales that happen at Christmas and holidays, right?
Correct.
So those stores, they're dropping their prices to drum up customers, for people to come to their shops and buy their inventory, right?
Yes, correct.
Are you there? Stay with me now. Follow me and speak to me. I want to make sure I want you to get that you understand this. All right. Okay. If you're having any issues understanding it, just let me know. Because what it is supply and demand is just like the way, they say, the way you buy anything and the way you sell anything in real life. That's the way it is. We're just looking at charts because they represent price. But it's exactly the same thing we're doing. When something is, whether it's a house, a car, a watch, a shoe, whatever it is, when something is cheap and getting cheaper and cheaper, more and more people will be interested to buy it. Something that was expensive for them before has suddenly become cheap.
Okay.
So it will drum up interest for them to buy. So when prices are falling, the demand is actually increasing, and actually it's becoming less and less attractive for the people who are selling to continue selling because they're not making any money. So if I had something I was selling at 100 Singapore dollars before, and now I'm doing a sale, or the people are not really interested in buying it because there's another product and it's now too expensive, and I make it now $60. So if I was selling it at 100 and I was making a profit of 10 Singapore dollars, so I bought it at 190 bucks. I bought it at 90 and I'm selling it at 100. So my profit margin is 10 bucks, right? You understand that as a banker, right? So I'm the owner of a shop. I buy, say I'm selling cups. I buy a cup at 90 bucks. I sell it at 100. I make 10 bucks, right? On each cup.
Correct.
Now, because of the fact that nobody is interested in buying this cup anymore because it's too expensive at 100 bucks for a cup, and I still have so many cups in my warehouse that I haven't sold.
Okay.
So I now drop that price from 100, drop it to 6 bucks. I still bought it at 90.
Yep.
But I now dropped the price at 60 bucks so I can clear my warehouse.
Yeah.
So now I'm making a loss, aren't I?
Yes.
So what is happening when prices are dropping? The demand for it. So all of a sudden, people are seeing this cup that was 100 bucks, and now it's now coming down and it's 60 bucks. They're going to buy tons of it. They'll buy the whole warehouse because it's now cheap. So they're the ones who are getting the better deal. Me, as the person selling, I'm losing money.
Correct.
It's becoming more and more difficult for me to make money selling this thing. So demand increases as prices drop, and supply decreases. Supply is the willingness to sell. If you were selling when things are high, did you guys have the house price crash in 2008 in Singapore? Did it reach Singapore?
Yes.
It affected you badly?
I mean, prices were down by about 50-60%, I guess.
Wow. Okay. So imagine the people who bought in 2008. They lost money, right? The people who bought at the top of the market. This represents the top of the market before the fall happened, right? So they're buying their houses here when it's so expensive. House prices have been going up for many years, right?
Yes.
And then they were buying when it was high here before the fall. Now, who made money? The people who bought in 2000 and 2001 and 2002, when prices were low down here, are the ones who made money. The guys who bought up here lost money because prices fell significantly after they bought. So the interest to sell was here when they were buying.
Okay.
When they didn't buy the houses in 2000 when the houses were 100,000, 200,000. They went and bought the houses when the houses were now 500,000 and 600,000, and everybody was saying, "Oh, house prices can only go up. It's brick and mortar. It will always be there. It will never decay. It's a strong investment. Buy a house." And then they bought at the high of the market, going into negative equity and all of this.
Yep.
And then the prices fell. I hope you weren't caught in that.
I was young at the point.
Okay, so that happened for people. So when prices are falling, demand is increasing. Demand will keep increasing until it gets to a point where that demand is so much that it will overcome the selling that has been happening. So selling has been happening and nobody willing to buy, prices are falling. So people are dropping their price to drum up business for people to buy their products. And then all of a sudden, as the demand is growing because things are becoming cheaper and cheaper and cheaper, people are like, "Oh, I'll buy 10, I'll buy 50, I'll buy 60. It's really cheap." And then the demand has gotten to the point where it's so large that it will power the selling that is happening. So the buyers will start to outweigh the people willing to buy, who are keen to buy, who want this thing, will be so many compared to the people who have it and want to sell it. So the people who have it and want to sell it can now raise their price and say, oh, so you want it? Okay, I've got it. It will cost you 300,000 if you want it. But it was only 250 yesterday. Well, do you want it or not? It's going to cost you 300,000. And you're thinking, man, I really want it. So, okay, so you buy it. And then the other guy comes and he says, so this guy paid 350. He paid 300 for it. So the next one that comes, I'm going to charge him 310. Because there's a big demand for this. So that's how prices end up going up and going up, because all of a sudden there's a big demand now for this thing. Everybody wants it. So the people who have it can do what they like with the price. They can increase it if they want. They can make it the same. But it will go up. You understand that concept?
I do.
Okay. So then again, prices will rise until such a point where it becomes too expensive. So instead of now costing 300, it has risen so much, it's now costing 500 and 550. And the buyers are like, whoa, that's a bit too expensive. That's a bit too expensive. So then all of a sudden that demand begins to dry up. Again, people who have it, again, now have to drop their price to be able to get people interested in buying it again. They drop the price up to a point where the demand again gets so much that it far outweighs the selling that has been happening. So the demand is so high that they can then again begin to raise their prices. Yeah?
Yep.
So that's the concept. What you are going to learn is how to identify that on a price chart.
Okay.
So first things first, have you decided what type of trader you are, having looked at your life and your circumstances right now, what time frames you're able to look at realistically and trade?
Probably I'm going to go for one weekday kind of chart, the kind of trade setup.
The monthly, weekly, daily?
Correct.
Okay, good. So that decision has been that because you're in a full-time busy job, you don't have time to be in front of the charts all the time. You have time in the evenings when you get home to be able to look at the charts. Maybe you can monitor your trades over your phone during the day, that kind of thing. But you're not doing analysis on your phone. You're doing your analysis at home. You could use your phone to execute. Good. So you've done that. Good. So looking at when we are trading this methodology, the minimum number of charts you should use is 3 charts.
Okay.
And they're all in sequence like that. So we think in terms of income, because the reason you're trading is to make an income, whether long-term income or short-term income. So the time frames that you look at, if you're going to be looking to make monthly income from trading, the time frames you will look at will be the monthly, the weekly, and the daily. And I will explain each chart in the series has a function.
Okay.
No, you don't do exactly the same thing all the charts. Each chart in your sequence has a primary function, as I call it. You can do anything you can do the same thing on all the charts, but understand that each one has a primary function which it must serve. So now, if you are going to do weekly income, which you're not going to do, but it's important for you to also know, if you're going to say you were trading for weekly income, meaning maybe you had some time during the week to be looking at charts, or you were working part-time and all of that. So your weekly chart would be your biggest time frame. Your daily chart would be what we call the intermediate time frame. And then your 4-hour chart will be your execution time frame. Are you following?
Yes, I am.
Any questions so far?
Nope.
Okay. So if you are looking for daily income, meaning you're at home, you're not working, you're a full-time trader maybe, or you have your own time, you'll be looking at daily charts as your biggest time frame. And you could look at either daily, a 240 and a 60, or you could look at a daily, a 60 and a 15-minute chart. All right. So the combination that, say, even if you were a scalper and you were looking for hourly income, then the 60 minutes will be your biggest time frame. And you could do a 60-minute, a 15-minute for your intermediate time frame, and then a 2-minute for your execution. So what I'm trying to say, you'll notice something. When we talk about monthly income, monthly chart is the biggest time frame. When you're looking for weekly income, the weekly chart is the biggest time frame. When you're looking for daily income, daily chart is the biggest time frame. That will help you remember the sequences. When you're looking for hourly income, the 60-minute, the 1-hour chart is your biggest time frame. Okay? So when you're discussing your trades, for example, on the round table, many guys will immediately, the guys will ask you, what sequence are you looking at? This is what they mean by that.
Okay.
Because some of them will be going long in trades that you're going short. That's because you're looking at different time frames. You're looking at different time horizons. You might be going for a longer term monthly, weekly, daily trade, whereas I'm taking a 60-15-2 and I'm trying to take a quick scalp or one trade. All right, both trades could work, and you won't say, oh, but I'm going long, why are you going short? And what it just means we're looking at different time frames. Okay. So to the functions of the charts, each one of the charts. So we have in the charts we have the higher time frame chart, or big picture higher time frame chart. We have the intermediate time frame chart. And we have the execution of entry time frame chart. Okay. Now, each one of them. Yes.
Can I just ask something?
Yeah, sure.
When I'm going across, going through forex factory, I've noticed that there are people that are actually posting. I guess they're looking at more of a daily income or hourly income kind of thing. I mean, as comparing to in terms of hit rate, when you compare from a monthly, a weekly, daily, and hourly, I mean, which is the more logical way of doing this supply and demand? I mean, which has the more successful way of doing it?
Supply. This is a very important question, and thank you for asking it. One thing I want you to understand from today, that question you asked is it's something that retail traders are taught, and it is so incorrect. The hit rate of any methodology is determined not by methodology. It is by the person applying the methodology. So retail traders are told, oh, I have a system that works 80% of the time, and you go and buy that system. So why can't people reproduce that? Because it is never the methodology, it is always the trader. There are people making money, Aloy, with moving average crossover. There are people making money with head and shoulders, people making money with Elliott wave or volume spread analysis. Supply and demand is not the only way to make money in the markets. It is one way that will give you a framework for you to understand what the market is doing on multiple time frames and give you opportunity to profit from it. But there are traders who are not successful using Elliott wave, just like there are traders who are not successful using moving average crossover. And there are traders who are not successful using supply and demand. So it is never about, so if I said to you, oh, if you use monthly, weekly income trade, you will have 60% success rate. That would be wrong, and that would not be fair on anyone to be told that, because there are traders who will be trading that same sequence who are having 65%, 70%, and there will be traders who will be having 30, 40% success. It all depends on the trader. What you are learning, the methodology you are learning, is for you to have the knowledge to be able to draw money from the market. Now, how you apply it is where we need to get into your mind over the course of the next so many weeks. We need to get your mind understanding why you are doing what you are doing and the way to think to be able to produce wealth from the market. I want you to, if as much as you can, I want you to forget about all that you have learned about trading, whether in terms of, I know that's hard to hear for people, whether it's about, oh, how you need a system that is 20% successful or 60% successful. In one of the sessions, if you remind me, I will ask me about what I call trader maths. And I will show you that even if you have a system that is 30% accurate, you can still make a heck of a lot of money. With 30% accuracy. All you have to do is switch the risk to reward ratios. That's all you need to do. So if you have a 30%, for example, I might as well give you a little primer now. If you have a system that you do your trades and you notice that you have a 30% hit rate, 30% accuracy, to make money, all you need to do is make sure that your winners are 3-1, and you will be making
I saw this discussion on WhatsApp actually. I mean, there was a trader who was talking about, he's making a 1-3, 1-4. Then I think Dennis actually commented that, you do not have to make, you do not need to have a high hit rate. Just you have to ensure that, you're taking decent and well enough risk to reward.
Correct. And that's what I have taught them, that don't be, because like you, all of them, when they came into the roundtable, everybody had these preconceptions, things they've read on Forex Factory, things they've read in books, or things they've heard in webinars they've attended before for retail traders. But you have to understand that trading is a very personal thing. I might be somebody who is taking trades and all I want is 2-to-1s. Well, if I'm getting 2-to-1s and I'm good at my methodology, I could have a 60% hit rate. I will be killing it. I will be making a heck of a lot of money. But there will be other guys who their hit rate is about 40%. Well, they will need bigger risk to reward ratios. Neither of us is better than the other. It's not a question of that. Trading is never about who is better than one trader or the other. It's always about you, how you improve, how you better yourself. So if you know you have a 40%, you've done your work, you've documented your trades, you're going over your trades, maybe like this time of year when things are slowing down and you have a bit of holidays, you want to review your trading for the year, like me, and you think, oh, well, I have a 5% hit rate, for example. Okay, so that means going forward, maybe I need to start focusing on mainly 2-to-1s or 3-to-1s to do that and make sure that my risk to reward ratio will fit the hit rate. And if my hit rate increases and I can still maintain like a 3-to-1, then I make a heck of a lot of money. So that's the way you have to think about it. Okay?
Okay.
Does that answer your question?
Yes.
Okay. So we were talking about the time frames, the functions of the time frames. Yeah? So we've got these three time frames. We said you use a minimum of 3 time frames. The higher time frame chart is what we use to determine what we call. You've probably heard the guys talk about it. I talk about it in the material I sent you as well. Curve. So the supply and demand curve. Let's look at it. Curve just refers to the higher time frame levels. So for example, if you're trading a monthly, weekly, daily sequence, let's pick a chart. Pick one chart from here. Any pair. Pick a pair.
Dollar yen looks interesting.
Dollar yen. Okay. So let's start with your sequence. So this is dollar yen.
Okay.
And you are a monthly, weekly, daily trader. So monthly is your biggest time frame, correct? Correct. Okay. So you are looking for curve. You start with current price. You're looking for the fresh supply above current price. You know what fresh means? Fresh means. Go on.
The previous uptrend, which is your demand.
No, freshness, the concept of freshness means that, let me reduce the font of this thing, it's taking up a lot of space. Can you still see it at 16? Yeah, okay. So freshness means that since that zone was created, whether it's a demand zone or a supply zone, since it was created, price will come back to it.
Okay.
Okay. So, for example, this zone. Do you see this?
Yes.
Freshness is assessed by looking to the right of the zone, always. So this is the right of the zone, all this. So this zone, when it was created, when the chart was like this, when this market was like this, prices dropped from here and they fell, they fell, they fell. Has price come back to it since it was created?
No.
No. So let's move forward one by one and see. Have prices come back to it yet?
No.
Have prices come back to it yet? No. This zone is fresh. What about this zone? This one. So this zone was created, right?
Correct.
Moved away from it. Have prices come back to it yet?
No.
What about now?
No.
What about now?
No.
What about now?
No.
What about now?
Yes.
So at this point, that zone was no longer fresh. Until that happened, that zone was fresh.
Correct.
Since it was created, price had not come back to it. And then when this happened, it was no longer fresh because this was price came back into that area for the first time since it was created. Okay?
Correct.
So this one, it has been created, prices are they're getting close, but they haven't come back to it just yet.
Okay.
Okay? So that's a fresh zone. So when you are looking at your zones, you're looking on your curve time frame, and the curve is what we will do today. That's all that we will do today because we're going to do it one step at a time.
Okay.
Curve supply. Now, where is curve demand? How do you locate demand or supply for that matter? How did I locate this supply?
The drop in supply that has taken previous uptrend.
Yeah. So this drop, you mean?
Correct.
So you must have read it in the document. There are 3 steps to identifying supply and 3 steps to identifying demand. You always start with current price, where price is. This is current price, right?
Yes, correct.
When you want to identify supply, supply is always above current price, always. Demand is always below current price. There are always sellers above where price is who want to sell it, and there are always people below where price is who want to buy it when it becomes cheaper, when prices fall. Does that make sense?
Yep, it makes sense.
Okay. So you start with current price, you go up and left. What are you looking for when you go up and left? You're looking for big drops in price when you're looking for supply, and you're looking for big rallies in price when you're looking for demand. So that's how I identified this supply. I started here, I went up above this candle, looking for an area where a big drop in price occurred. When you find the big drop in price, you trace it back where it started from, and that's where you will find the origin of that drop.
Okay.
Do you see that? So start one, locate current price, easily done. Step 2, to find the supply zone, go up and left, looking for a big drop price that is above current price. Step 3, trade that big drop back to where it started from, and that's where you have your base.
Okay.
Read that part of the document again as well. Step 1.
So for the place where you draw the box, is it a 50% candle?
Yeah, you can use the 50%. You can use so this is the leg out. This is the did you read the bit about the leg out and leg in?
I don't really get what you mean by the leg out and leg in.
We're talking about the basing. So the leg out is the drop away or the rally from. In the case of supply, the leg out. Let's do it. This is good. I like this. The leg out is the drop away from the base. It should consist of expanded range candles or a gap away. Yeah?
Okay.
In the case, so the leg out is a drop away from a base in the case of supply, or the rally away in the case of demand. So let's go over it. So when we say leg out, so I said step 1, we start with current price. Step 2, we go up and left. We're looking for a big move down in price, a big red candle. We have found the big red candle. This is the leg out. This candle is the leg out. The leg out of what? The leg out of the zone, the supply zone. So when you find the leg out, which is it's always a big red candle that we call expanded range candle or ERC, you trace that expanded range candle back to where it started from to locate the base. So do you understand it up to that point?
Yes, I do.
Okay. Now, when you've traced it back to where it is, you now say, okay, I've got the leg out. Where is the base? Now, the base is usually, not always, but usually made up of 50% candles. Do you know what a 50% candle is?
Candles that are small?
The definition of a 50% candle is a candle whose the range of the open to close of that candle is 50% or less of the range of the high to low of that candle. And I will give you an example now. Say you have a candle like that. Can you see that?
Yes.
And say you have, I want to draw a line. How do I draw a line on? Okay, so let's do this. So let's say you have, this is the wick of the candle, the top, and this is the wick at the bottom. Got it? Now let's say this price here, the high of this candle, let's say at $10. And the low, let's say the low of this candle let's say the low is at $5. Oh man, come on. Okay. You following so far?
Yes.
Okay. Let's say the low is at $5. Now, the open, let's say the open here is opened at $6.
Okay.
So this is, we're assuming this is an up candle, right? Like it's maybe we should make it green. Yeah, let's make it green. Let's make it green. Okay, so it's an up candle. So $6 was the open. The low of the candle was $5. Let's say it closed at $9. Yeah. Okay. So a 50% candle. Remember what I said? A 50% candle is a candle who the range of the open to the close is less than 50% of the range of the high to the low. So what is the range of the high to the low in this case?
5.
5. Excellent. And what is the range of the open to the close?
3.
3. So 3/5 is what in percentage? 60%, says the banker. Well done. Times 100, right?
Yep.
So, Aloy, Chiwe, right?
Yes.
I'm practicing my Singapore name. So, 60%. Is that a 50% candle?
No.
Correct. It is not a 50% candle. Why?
Because it's more than 50%.
Correct. So any candle that you have in the base, and do you use TradingView or you have another platform?
I just created a TradingView account, but I still have to play around with the platforms.
So TradingView has they don't pay me for any of this or anything like that, but they have there's an indicator that you can get for free on TradingView that actually colors in the 50% candles.
Okay.
Let me show you what it looks like. So if I apply it now, you see the colors change?
Yes.
Let me make it a different color for you. 1 second. Okay. So you see all the orange colored candles?
Yep.
Those are candles where the range of the open to the close are less than 50% of the range of the high to the low. Those are the 50% candles. All of them there, and they're all colored in throughout the whole chart. And that's just using an indicator. But what I want you to do is, I don't want you to rely on this indicator. I hardly ever use it myself anymore. I want you to train your eyes to see the basing. So the way I've drawn it, for example, now, if you were just focusing on just the basing candles, you would be saying, oh, okay, then should you not be drawing it like this? But that's not actually this is the whole area. You want to make sure. So we've done leg out, right? The big expanded range candle that comes out of a supply zone, or if it's for a demand zone, this is the leg out of this zone, for example, the big expanded range green candle. So the movement out of the zone is the leg out. If it's going down, it's the leg out for a supply zone. If it's going up, it's the leg out for a demand zone.
Okay.
Now, so this is the leg out, and then we said after leg out, we go basing. The basing candle represents where the orders are sitting.
Okay.
So that's the next thing. So from leg out, we go basing. And then once we identify the base, meaning the origin of that leg out. So remember we said step 1, current price. Step 2, go up and left, looking for a big drop in price, which is the leg out. You found the big drop in price, which is the leg out. You trace it back to where it started from. That's where you will find your base. You've located your base using the 50% candles also as well. That helps. It's not the only thing, or it's not that every basing has to have a 50% candle, but it helps to be able to see it. You've located the base, and then your next one, the last bit of it, is the leg in, isn't it? Are you there?
I am.
So the leg in, again, is made up usually of expanded range candles. This is how you identify the zones that where you're going to be trading, expanded range candles. So for example, this one, let me blow it up. This one, you have the leg out, you have the basing. Is this a 50% candle?
No.
No, that is the leg into the base. So the very first non 50% candle after the basing is the leg in for any base. For example, this drop, base, drop. You see how prices came back to it? Fell?
Yep.
Do you see where prices came back?
Yep.
Right there. So when this market was like this, when it was like this, you had a leg in, big expanded candle, leg in, a basing, and leg out. So if I said to you, when this market was like this, if I said, find me the nearest supply zone, you would start with current price, which at that time was this one. Correct?
Correct.
So you would start with that current price, you go up and left looking for the origin of this big move. You find the origin, you find where it started from, you find that you have a basing candle in there, and then you keep going left. There might be 2 or 3 or 4 or 5 or 6 or 7 basing candles, but when you go left, the first one you find is not a basing candle. Immediately you know that is your leg in. So you have a drop, a base, and a drop. This is one of the 4 patterns. This is one of the 2 patterns of supply. There are 2 patterns for supply and 2 patterns for demand. So this
the
is
other
the
is,
sorry?
The other is the rally base drop, right?
Correct. Correct. Which is that kind of rally base drop kind of thing. So you're looking at tops and then you're looking at continuation patterns. So this drop base drop is a continuation pattern. The rally base drop is a reversal pattern, which usually happens at extremes, highs like this one. And this one happens after a trend has already started. So for curve, again, to summarize, you are looking at your biggest time frame. You're looking at trend primarily on that biggest time frame. You're looking at the curve. You're looking at the big picture zones. Where is the first fresh supply zone above current price on my monthly chart? Where is the first fresh demand zone on my monthly chart below current price? So we've done a lot of work on identifying the first fresh supply zone above current price, the first fresh demand zone below current price, going through the same methodology again, starting with current price, going down, identifying a big rally in price. I'm talking to a lawyer, baby. All right, you have to be quiet, or I'll tell a lawyer to come and carry you away from Singapore. Okay? So shh. You want to go to Singapore? Sorry, lawyer, my daughter just came in the room.
Okay, it's fine.
Yeah. So you start again. Now we've done supply. You happy with supply?
Yep.
So demand is what I want us to do now. So again, you always start with current price. You're looking for a big rally in price. Do you think this is a big rally?
I think it is.
It is. It is. So you found the big rally, and now what do you do when you find the big rally? You trace it back to where it started from. And that big rally started from somewhere in here. Now, we've just said you want to make sure as often as possible that you have base in candles. Is this a 50% candle? Let me just blow it up. This one, is this a 50 candle?
No.
Is this one a 50% candle?
No.
These are the 50% candles, right? So your zone is actually like so. The origin of this big rally in price started from inside here. It's not a great zone, but it's more than enough for your curve. Yeah, the reason I say it's not a great zone is because of this wick. So when prices left the zone, when the zone was like this, when the zone was being created, prices came back to it with that wick. But it is still the nearest demand zone. Yeah, it's still the nearest demand zone. So here you start with current price. You're going down, looking for the origin of a big rally in price. You identify your big rally, and then you go down to the origin of the rally.
Okay.
Give me 1 second, Aloy. Let me just throw my daughter out of the window for a second.
Okay.
All right, come on, let's go. Let's go, Liz. I'm coming in the meeting.
I'm trying to get a job from Leah.
Okay. No, I haven't. Be glad you don't have kids yet, Aloy.
I must have made your daughter cry.
Huh?
I must have made your daughter cry for you not spending enough time with her.
Yeah, it's your fault because I'm spending all my time with you instead of her.
Sorry, man.
You have a girlfriend?
No,
Not yet.
not yet.
Okay. All right. So this is your, for now, so based on current price, this is your curve. I'm going to take it one step deeper now. So you've identified fresh supply above current price. You've identified fresh demand below current price.
Okay.
Are you happy with that?
Happy? Trend line?
No. We're not doing trend lines today. One step at a time. Don't try to learn it all in one day.
Okay.
Okay. What I want you, so your homework for this week will be to go away and send me 3 charts, whatever time frame you like, whatever pair you like, but make sure I want 3 monthly charts actually, because you're a monthly, weekly, daily trader primarily. So send me 3 monthly charts with the curve identified, the current curve, fresh supply above and fresh demand below. That's the homework for the week.
Okay.
So when you've identified your curve like this, what this information tells you, remember the curve is your biggest time frame. What this tells you is this is an area when prices are getting near here, I don't want to be buying anymore. When prices are getting near here, I don't want to be selling anymore. I want to be looking for opportunities to sell if and when prices get here, and I want to be looking for opportunities to buy when prices get here. You haven't looked at any other charts. You're still on your biggest time frame, and you already have a decision. You already have an idea of where you want to buy and where you want to sell. As we going ahead week by week, you will talk about your entry tactics, how you assess the trend, because we're not looking at the trend on this time frame. The trend is actually going to be looked at on the intermediate time frame. That's the primary function of the intermediate time frame. The primary function of this biggest time frame is for you to identify the big picture levels where you don't want to be a buyer and where you don't want to be a seller, and where you would be looking for sells and where you will be looking for buys.
This is based on the. Sorry,
this
is based on the. I did see you draw some Fibonacci retracements from the bottom of the.
So that's the next stage. They're not Fibonacci retracements. That's the beauty of it. This is something I don't teach to anyone outside of the. So when you're posting charts on Forex Factory, don't include this tool on it. What it is so what you know is this is too high to buy. Let's type it in. Let me type that in for you. This is where you want to sell. It is too high to buy. This is where you want to buy. It is too low to sell. All right. What we call this is what we call, because people are always saying, oh, it's high on the curve. They never tell you how did they arrive at that conclusion. This is what we call very high on the curve, when price is actually at the big picture zone. That's very high on the curve. Actually, I'm going to take these out first, so I want to delineate it. So this is what we call very high on the curve, when price is actually at the supply zone. And this is what we call very low on the curve, when price is at the monthly demand zone, or your big picture demand zone, whatever your big picture is. Now you have this space between the two of them, from this proximal line to the proximal line, this space between them. Now what you call the Fibonacci tool is actually what we use the Fibonacci tool as a measuring tape. It's nothing other than that. What it is we are dividing this distance into 3 equal parts. So you will see, if you use whatever platform you use, you will see it divided like so. If you have a Fibonacci thing in that platform, I want you to modify it to, is it MT4 you use?
Yes, I am using MT4.
Okay, so I think on MT4, I think it would be 66.66 and 33.33. So you're dividing this distance into thirds, into 3 equal parts. Okay. So whatever this distance is, it doesn't matter in pips, it's irrelevant. You get your fib tool and you change it. So what I want you to have on that, it's you can call it a modified. That's the way I refer to it. But what I want you to do is to understand that you're not using 0.618, 78.6 and all this other stuff. All you want is the 0, the 1, the 0.33, or in I think in MT4 is 33.33%. It will come up as, and this one is 66.66. Those 4 points are all you need.
Okay.
You'll notice they're not Fibonacci numbers, because as I said, we're just using it as a measuring tool. Okay, so when you have that like that, you put it on and you say, okay, so where am I on the curve?
You're at about 89%.
Where am I right now? I'm between 66 and 100, aren't I?
80-90% of the curve.
Yeah, but it's just enough. It's just for you to know that you're between 66 and 100. So that this area between the red line and the proximal line of the supply is what we call high on the curve. And you will understand these are the areas that will, wherever you are on the curve is what determines the most appropriate action to take, whether to be aggressively buying, aggressively selling, conservatively buying, conservatively selling. We'll go through it. The area between 33.33 and 66.66 is called equilibrium. That area is where trend trading is important. I don't care. I don't care about trend when I'm high on the curve or very high on the curve, because the trend will be up anyway. Remember, we're not looking at trend on this time frame. We're looking at trend on the intermediate time frame. But let's finish this first and we'll talk about it. So when price is between 6% and 100%, you are high on the curve. When price is between 33.33 and 66.66, you are in equilibrium. When you are between 0 and 33.33, you are low on the curve. Do you understand that so far?
Yes.
Now, when you have because this is the picture I want you to send to me for those three charts. Identify the big picture supply, identify the big picture demand, identify where price is on the curve. I want these things drawn out as well to make sure that you understand the concept. Okay, so when you are very high on the curve, number one, these are the decision points. Number one, when you are very high on the curve, do not buy. You are allowed, exactly. You are allowed to start looking. Not that you should sell, you start looking for selling opportunities. They may happen, they may not happen, but at least you know I'm in sell mode. I'm not looking for buys, I'm looking for selling opportunities. And then if you have been long from below, you know you definitely want to be exiting any longs you have from below. Say you were fortunate to catch a long here on a smaller time frame and you manage to carry it all the way. When you're here, you want to be exiting your positions, taking your profits. So these are the three things when you are very high on the curve. Number one, not allowed to buy. Number two, you can exit any positions. If you are lucky enough to get them, you exit any long positions you're carrying from below, because prices are getting very expensive now. You exit any longs. Number three, you are allowed to start looking for selling opportunities, which may or may not happen. Okay. Do you understand that?
Yep.
When you are high on the curve, number one, do not buy. Number two, you are allowed to start looking for selling opportunities, but better to wait for price to reach curve supply. You're allowed to look, because sometimes price may just not get there, it may just fall short of it and it will start to turn, because it will be creating a new supply zone. So you are allowed to start looking. It's better for it to reach the curve supply zone, but at least you know you can start looking, and definitely not buying anything. All right.
If you're looking for a selling opportunity, and I mean your intermediate frame tells you that this is a place where buying.
Say again.
I mean, in the intermediate time frame zone, is identified that you can actually take this trade, right, to go short. But is this more aggressive kind of trader that they're actually taking this position way earlier than moving to the curve?
Yeah. So the trade you take here, remember, aggressive doesn't mean bad. I want you to understand that. Aggressive. In fact, if you're an aggressive trader, has better risk to reward ratios, but he also has a lower win rate.
Okay.
So if you're an aggressive trader and you say, yes, I'm allowed to look for shorts here, I don't necessarily have to wait, and I start looking, and you start taking your shorts here, you more times than not, you will get a few more stop outs than the guy who's waiting to be shorting up here, because sometimes prices will not get to here. Like I said, they'll stop short, and those times the aggressive trader will be in the trader, and you, the guy who's waiting for price to get here, you will have to wait and make sure that the trend has turned and all of this for you to start getting in. But the aggressive supply and demand trader is already in because he saw that prices were high on the curve, and he's already looking for those selling opportunities. His antenna is up, and he's actively looking for evidence that selling is beginning to come in. The evidence will be on the intermediate and the smaller time frames, not on this time frame. So focusing just on this time frame. This time frame is what helps you decide what to do and what not to do. So when you are high on the curve, do not buy. You are allowed to, the aggressive trader is allowed to start looking for selling, and again, start exiting your longs that you carry from below. So basically what we're saying is when you are high or very high on the curve, you're not allowed to buy. You exit any longs that you have from below, and you're allowed to sell, to start looking for selling opportunities. Those are the three things. When you're high on the curve, you're not allowed to buy. You can exit any longs you're carrying from below, and you're allowed to start looking for selling opportunities. Any questions on being high on the curve?
Nope.
You good with it?
I'm okay.
Okay. Now, opposites for when you are low and very low on the curve. When you are low and very low on the curve, number one, do not sell. Prices are too cheap. The profit margin is low. You have a big stack of buyers right here. If you're selling into this, the probability of the trade going against you when these buyers take control is going to be very, very high. Do not sell when you are low and very low on the curve. Number two, you can exit any shorts you're carrying from above. Let me just say, exit any carried shorts. So if you are fortunate enough to get a daily supply zone up in here or up in here to short, and you've been letting your profit run and prices are now getting low on the curve, start taking off some of your profits, exiting some of the positions because you know demand is beginning to increase. Because why? Prices are falling. What happens when prices are falling? Aloy, what happens when prices are falling?
When prices are falling,
what happens to demand when prices are falling? Demand is getting more when prices are falling, isn't it? So, and by the time you are very low on the curve or low on the curve, the demand is quite high already. So you want to exit any of your shorts that you're carrying. And then finally, you are allowed to start looking
for longs.
For longs, correct. Well done. Very good. That's it. So that's for when you are very low or low on the curve. You'll notice that I have not mentioned trend at all, because when you are high or very high or low or very low, the trend is irrelevant in the sense that, so for example, the trend time frame for the monthly, weekly, daily sequence is the weekly trend. Again, this is private information. Obviously, you know that, so this is not to be shared publicly. Monthly, weekly, daily sequence. The weekly is the trend time frame. We don't look at trend primarily. So what is the monthly trend? Oh, the monthly trend is up, so I want to be a buyer. That makes no sense whatsoever. Not for real life trading. If the monthly trend is up and the weekly trend is up and the daily trend is up, it's actually extremely unsafe to buy, because what that is saying is that prices are very, 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 very stretched. You don't want to be the guy in 2008 buying at the high of the market just before the crash. So your primary function looking at your biggest time frame, which you have decided for you is the monthly chart. The purpose of that monthly chart is for you to identify the location of price on the supply demand curve. And how do you identify curve? It's by identifying the fresh supply zone of current price on your monthly chart and the fresh demand zone below current price on your monthly chart. And then you take your modified fib tool and you measure that distance between the proximal line of your fresh demand and the proximal line of your fresh supply. You divide it into 3 equal parts and it gives you 5 divisions in total. The supply zone itself, which is very high on the curve, between 66.66 and 100, which is high on the curve. Equilibrium, which is 33.33 and 66.66. Low on the curve, which is between the proximal line, 0, and the 33.33% is low on the curve, and inside the demand zone itself is very low on the curve.
Okay.
These divisions tell you what you are allowed to do depending on the location of price on your curve. So in this example, we've identified that price is between 66.66 and 100%. Correct?
Correct.
By our definition, that is high on the curve. So with each one of these divisions, we're allowed to do, there are three things. Number one, when you are high or very high, you are not allowed to buy because it is too expensive. The trend is already up and you are probably very close to a big picture supply zone. So that is why you are not allowed to buy when things are expensive. You should have been buying when things are cheap, just like you would do in your everyday life. When you go to buy a laptop or you buy a car, you want to buy the car when it is on sale. You want to wait for Black Friday and buy it when it is 50% off. You want to buy it when it's cheap, not after it has risen, 20% or 30% or 40%. That's too expensive. You want to be buying down in here and taking it up with you and getting the profit, not buying it when it's already way up here after all this big move in price.
Okay.
Okay? Just like anything in your usual life. If you're going to buy a watch, you're going to shop around looking for the best deal. If you're going to buy a shirt, you're going to shop around looking for, a nice shirt at a reasonable price. It's exactly the same thing in the market. If you're going to buy a car, you will shop around which dealership is doing any deals, any financing, the best deal you can get. That's exactly the same thing you do in the market. You buy low and sell high. Nobody ever tells you, what do you mean by low? What does low mean? What exactly does low mean? How do I know prices are low? This is how you know. Identify fresh supply above current price. Identify fresh demand below current price on the big picture. That is what will tell you what is cheap, demand, and what is expensive, supply.
Okay.
Do you understand?
Yes.
Good man. So the homework for this week is 3 charts. You don't have to send them all at once. You can send me one on Tuesday, one on Thursday, one on Saturday. It doesn't matter. I don't care. But what I want is for you to identify on those charts, use monthly because you're a monthly, weekly, daily trader. Identify fresh supply above current price and fresh demand below current price. Use a fib tool and divide that distance and write out these things for me. Very high on the curve, equilibrium, low on the curve.
Okay.
And then very low on the curve. Now, finally, before we finish, let's talk about equilibrium. Equilibrium is where trend matters. The definition of trend that we use, we'll talk about trend in the next meeting. The definition of trend that we use, trend is the movement of price from higher time frame demand to higher time frame supply. That's an uptrend. The movement of price from higher time frame supply to higher time frame demand, that's a downtrend. The trend is identified on the intermediate time frame chart. You can identify trend on the curve chart, but that's not the primary function of that big picture curve chart. The main chart, the primary chart where you identify trend is the middle chart. In your case, as a monthly, weekly, daily sequence trader, your trend is on the weekly chart. So, what is the trend, Aloy? You see I've kept correct, uptrend. But you see the lines now, you see the trend, the movement of price from big picture demand down in here is going towards where? Big picture supply.
Correct.
So this is how you make money in the market. What if you were the one who was buying down in here and you did your analysis and you saw this curve and you said, right, I bought really low on the curve. I'm going to hold this price. I'm going to hold this market. Now you are making a heck of a lot of money.
Yep.
So this is how you make money, by holding these runs. And if you go down to the daily, I bet you will find a daily entry, because the daily will be your entry. Just look at that. You see the basing candles?
Yep.
And the move away, demand zone on the daily chart for you to enter. So you would have been in this trade since the 9th of November, and you'll still be in it now. Wow, this is how you make money in the market, by identifying these zones, multiple time frame analysis. So for your trend, the trend is primarily identified on the middle time frame. In your sequence, monthly, weekly, daily, obviously the middle time frame is the weekly. So that is your trend. So when people say, what is the trend? The first question you must ask them is, what time frame are you talking about?
Okay.
Because there are trends on all the time frames.
Yeah.
What time frame are they asking you about trend on? All right. So we'll talk about trend next. All right. So remember, homework.
Yep.
All right. So send it to me during the course of the week.
I'll be able to use for TradingView to do my charts, right? It's free, right?
Yeah. It's free. It will only allow you to have one chart, though. It won't allow you to have 6 like me, because I use. It won't allow you to have this kind of setup. You'll only have one chart. But that's fine for this homework, because you're going to be just doing the monthly chart, so that's fine.
Okay.
All right. Okay.
Yep.
I'll send you the recording when it's ready.
Okay. Thank you very much, Michael.
No problem. Let me know if you have any questions. Just shoot me an email, okay?